Good evening, and thank you, Ralph, for pulling resources and hosting us here at the DVFA Center. So this is a joint lecture organized by the DVFA and the Center for Value Investing. And we're very pleased today to have Russell Napier. I guess he doesn't need too much of an introduction. He's the person to talk to when the question turns towards bear markets. And we've had 9 years of a bull market, so inevitably some point in the not quite predictable future, but sometime it will happen, the next bear market will start, and we're here ahead of the curve to prepare ourselves for that event to happen. Russell and I share one characteristic. Sometimes we say things that are not so pleasant, so sometimes the media loves us for it, sometimes the media doesn't like us for it, but that's the way the media goes. Russell, it's a great privilege, it's an honor to have you here. The floor is all yours.
Obviously, my main job is to go and see institutional investors and forecast the future. But I also run a course in finance called The Practical History of Financial Markets. So when I was coming this evening, I asked Max, which presentation should I do? Should I do the academic presentation, which focuses on why equity markets go up and down? Or should I do the kind of, if you like, the stockbroker presentation on where markets are going next? And of course, Max said, well, why don't you do both? So I'm going to attempt to do 2 one-hour lectures in 1 hour. And I'm also going to attempt to do that with what you have already discovered now is a fairly strange accent. So I'm going to try and go slowly because it's not easy. So there are 2 points to this lecture. One, why do equity markets happen, or equity bear markets happen? That is not the only thing that we teach on the course, by the way. We just don't teach bear markets. But given where valuations are today, it seems the most important element of that course to talk about tonight. And then secondly, why we are on the verge of a bear market today without interest rates going up. So we'll start with the conclusions. You might think they're assertions, but the point of the next hour is for me to back up these assertions. And we'll begin with the, if you like, the more academic assertions about why stock markets come down, and then to the current causes of our next equity bear market. So we're using a measure of value here, which when we started our course in 2004 was a fairly little known measure of value, and now everybody knows what CAPE is. Everybody knows what the Shiller PE is. It should more accurately be called the Graham-Dodd PE, which is to look at equities. The price of equities divided by the 10-year rolling average of the earnings per share rather than the current earnings per share, the rationale being that we are now looking at equities valued through the earnings cycle rather than at peak earnings or trough earnings. That's a well-known concept, and I'm going to look at that and spend at least 20 minutes talking about why that measure of value goes up and down, and then why it's coming down. The better measure, I believe, of value in stock markets is called the Q ratio. And for those of you who don't know the Q ratio, it's effectively a price-to-book ratio, but instead of using book, we try to use the current value of assets. So it's a book value, but it's adjusted. It's looking at the assets of a company, the net assets of a company, at their market value relative to price. This, we believe, I think we can show, is a better measure of value even than the cyclically adjusted PE. So you may ask, well, why doesn't everybody use this measure of value? And the answer is it's very hard to get, certainly in aggregate for most stock markets, but fortunately we can get it for the United States, and we'll look at that as a measure of value as well. The key to why equity markets go up and down is changing inflationary expectations. And that is really what I'm going to talk about for half an hour. How changing inflationary expectations can drive equity valuations up and drive equity valuations down. And I'm really talking about valuations here more than anything else. Deflation will bring equity markets down. Disinflation will put equity markets up. Stable inflation will send equity markets up. So these changing inflationary expectations are what we're going to talk about, and then I'm going to talk about why we're about to have deflation. Now, that is certainly not the consensus view of what's going on in the world. There is a little bit of mystery. You will know that central bankers are slightly mystified as to why inflation is coming down. I hope to answer that. And you might say, well, why is deflation so bad for equity markets? The answer is because it invariably brings a decline in cash flow. And a decline in cash flow for equities, if they have a high fixed cost, can eradicate the equity. The owner of a corporation with falling cash flow can often be the creditor and not the equity investor. And that is why historically deflation has been so bad for equity valuations. And I have at the bottom here the triggers for what I think will cause our next deflation, which I will talk about in some detail at the end. So Turkey, which is going bankrupt quickly. The yen, the central bank is pursuing a policy of outright monetary finance, not dissimilar to the Weimar Republic, and I don't have to tell you what that means. The Chinese exchange rate is overvalued. German life insurance companies are unable to get sufficient cash flow to meet their long-term obligations. Capital controls are likely in some emerging markets. The Eurozone is going through a political disunity, and there is excessive credit growth in 16 countries with prospects for banking crises. So Max did warn you that I would be fairly frank in these comments, and not all of those things will necessarily happen. But if any of these things happen, just one of these things were to happen, the market would instantly be looking towards a deflationary outcome and not an inflationary outcome. So that's a taste of what's to come. As you can see, it's not the standard optimism that is pervading markets at the moment. So let's look at this famous chart of the cyclically adjusted PE. Now, I once did a 1 hour and 30-minute presentation on this one chart, so I have to try and condense everything even further as to what we learned from this chart. Because I'm here to talk about why the valuation mean reverts, I think the easy way to do that is to talk about the really high levels of valuation and what causes them. Then talk about the really low levels of valuation, what causes them. And if we know the causes of the high valuations and the low valuations, we may be able to work out what drives mean reversion. So let's begin with the high valuations. And the first thing to point out is there are not very many of them. There have been a lot of business cycles over this long period. Equities do not get excessively valued at the top of every business cycle. I think I actually counted these a while ago, and there's been 20 business cycles since 1871 when this data begins. 1881 is when the first Cape data is available, obviously using earnings from 1871. But we don't get huge overvaluations of equities very often, but yet they do occur. You will know this chart is actually slightly out of date because the cyclically adjusted P for the United States has now gone through 30 times earnings. So it is now higher than it was. It's roughly the same as it was in 1929, and it is back where it was between 1998 and 2002. So there have really only been 5 years in US economic history where the equity market has been more expensive than it is today. So when we look at all those previous periods of very high valuations, why did they occur? And why do we care? And the first reason to say, why do you care, is that subsequent to this, returns were extremely low. How low is low? Well, obviously, it depends on your time horizon. But even taking a long-term time horizon, and let's take periods of 10 years plus, the return you get if you buy the US equity market at the current valuation should be about 2 to 2.5% real, compounded over the next 10 to 15 years. So that's 2 to 2.5%, dividends reinvested, real total return over the next 10 to 15 years. That's what we should expect. That's what it has historically delivered around current valuations. So one piece of really good news is, despite massive overvaluation of equities, in the long term, they should produce positive returns, even from this high level. Now, that's the good news. The bad news is most people who work in the business of investing money are not actually paid to forecast returns. They are actually paid to forecast the distribution of returns. I think you've all learned that, probably the hard way, that if you tend to be right but early or right but late, that's the important bit. It's the timing that's the important bit. And here's the problem. At a valuation at around current levels, it is perfectly normal to expect there to be 1 year or 2 years? Will you lose 40%, 50%, or 60% of your money in a very short period of time, or even over a prolonged period of time? But over 10 years and 15 years, you should still expect a positive return. And I think, depending on who your end client is, I think most clients would expect us to be doing something to avoid those significant capital losses when they occur. But anyway, good news, they still should produce positive returns. Bad news, you're going to get some very bad years in the next 12 to 15 years. Wouldn't it be nice if we could all avoid them? So what makes these periods different from the top of any other business cycle? And what makes them different is as follows. Investors believe in a combination which has never been delivered. And what is that combination? They believe that growth, and by which I have to ultimately mean dividend/earnings growth, they believe that growth can remain high and interest rates can remain low. And that's it. That's all you have to believe in, and you can believe in an incredibly high valuation for equities. That is Gordon's dividend discount model. It's a net present value calculation. The thing that drives the NPV number is the gap between the discount rate and the growth rate. And if you really believe we're in an economy that grows and produces growth in corporate profits, but interest rates never have to go up, 30 times is cheap for an equity. But what that chart also shows you is that we have never actually produced that combination of growth and stable low interest rates. We've never produced it in a sustainable basis that would justify that valuation. Now, I think, maybe as a cynic, I would argue that if it's never been produced in the past, maybe it just cannot be produced going forward. What we all know in a normal business cycle is that as growth accelerates, inflation accelerates. And as inflation accelerates, the discount rate goes up, the Federal Reserve moves the short-term interest rate, the ECB moves the short-term interest rate, long-term interest rates go up to reflect higher inflation expectations. So the nirvana that we all expected, rates stay low forever and growth is there, simply is undeliverable. And that is why in most business cycles, people do not price in this combination. So what happens in these 4 occasions, or now 5 occasions, that made people think this time it's different? And the answer is technology. A technology comes along that convinces everybody that we have found a new way of growing, that you can have steady growth with no inflation. And with no inflation, the discount rate will remain low in perpetuity. And therefore, when we do our discounting calculation of the future earnings, we're going to get a very high net present value, and we can justify these equity valuations, but it's fundamentally because we'll combine growth with no inflation. Now, it's never happened before. Now, obviously, the world is full of people who believe it's going to happen this time, and that is why we have this price. It's not that we observe that it currently exists, because it does currently exist. There is growth. There is certainly profit growth, and there is certainly no inflation. What the market has to price in is that that is the new normal, and that is sustainable. So let's talk about how the market has been wrong historically as a guide to how it might be wrong going forward. If you think about those 2 elements, there's really only 2 ways you can be wrong. One, you're wrong about the growth rate, in this case, corporate earnings and dividends, or 2, you're wrong about the discount rate. And what this chart shows us is if you're wrong about the growth rate of corporate earnings and dividends, equity markets can collapse. Let's look at 1929 to 1932, the most famous example. But we have many people in this room have also lived through 2000 to 2003 and 2007 to 2009. Look how rapidly stock markets came down in all 3 occasions. This is not a log chart, but if we had it on a log chart, you'd see in 1921 also a dramatic collapse in equity prices. Because what we got wrong was earnings. Now think of how that works in relation to that dividend discount model. We are at a high valuation because the discount rate is fairly low, and we expect it to remain so. And then the earnings growth disappears. In fact, in these occasions, earnings have contracted. And one of the things that ultimately or quickly springs to mind is, how do we stop this? Because interest rates are low. Where is the ammunition to turn this economy around? Because we're beginning with low interest rates. The Federal Reserve cut interest rates the day after the crash of October 1929. If you look at October 1929, investors weren't overly optimistic about the discount rate. They were overly pessimistic about the discount rate. For a very brief period in the early 1930s, the Treasury bill yield was negative in nominal terms. Now, I often hear people say, well, risk-free yields have never been negative in nominal terms before until recent times, but actually it's not true. Very briefly, they were negative in the 1930s on short-term T-bills, not like the German yield curve, but it's short-term T-bills. So people weren't wrong about the discount rate, but the earnings rate and growth rate was completely, totally, and utterly wrong. That is exactly what happened from 2000 to 2003, when our faith in corporate earnings collapsed, and obviously from 2007 to 2009. Using the Shiller data, corporations in America reported earnings that were back to 19th century levels by 2009, which is just nonsense. A myth of how we account for profits these days and how the balance sheet gets swung back and forward through the profit and loss account, and nothing to do with earnings. But anyway, the headline number showed that we were actually had earnings back to 19th century levels. So what I believe this chart shows is I'm focusing on tonight just on high valuations, primarily high valuations, because that's where we happen to be, and therefore hopefully that's of the most use. If we're wrong about corporate earnings, then the market will fall quickly. What happens if we're wrong about the discount rate? Now, at the end I'll talk about deflation, but of course I could be completely wrong. Maybe what we face is rising inflation, and at some stage we might have to face rising interest rates to deal with that. Well, there are some periods in this chart that show the stock market coming down, long bear markets, and we would associate them with investors being wrong about the discount rate. So in 1901 in America, investors are bullish. They're paying a very high valuation. They don't get earnings wrong. Earnings actually turn out to be pretty good. In fact, during the First World War, when America is neutral for most of that, earnings go through an unparalleled boom. And yet the stock market keeps coming down because warfare produces inflation. And in producing inflation, it takes the discount rate to a level that none of us would previously have contemplated in a time of peace and prosperity. And over a 20-year period, that market comes down. Now it ends with a deflation. It ends with a newly created Federal Reserve, created in 1914, driving interest rates up in 1919 to try and bring back the inflation. We get the worst annual deflation in the history of the United States, still 1921, and the stock market collapses to an incredibly low valuation. But the drift in valuations from 1901 to 1918 was not a drift with anything to do with corporate earnings. It was to do with being wrong with the discount rate. Many of us in this room have also lived through the 1966 to 1982 period, and we all know that that was a period when interest rates, particularly in America, went to levels that had never been seen before in the history of the United States of America. People were not wrong necessarily on earnings from 1966 to 1982. They were wrong on the discount rate. So the conclusion from that is, if what we're wrong about going forward is actually there's growth in inflation, equity valuations will actually fall fairly slowly, which I don't believe is the consensus. Most people's fear is that as the Fed tightens, the stock market will react incredibly negatively. I don't think it will, and I'll talk more about that in a little bit. It is probably going to be bad for equities in the very long run, but it can take a very long time, and it's a very, very slow process. So I'll talk about the deflation threat and why I think equities can come down very quickly and not slowly at all. A few other things I'd like to point out about this chart from an academic perspective. First of all, I think the valuation here tells us a lot about all markets. I think what it's saying is this: at a valuation of around 25 times cyclically adjusted PE, the market is pricing in a combination of growth and inflation which cannot be delivered by any economy. Now that's a big assertion. But think what the American economy has been since 1871. From 1871 really until 1914, this is an emerging economy. It is notorious for fraud. It is notorious for corrupt judges. It is notorious for no rule of law. It is a place that no proper investor would ever invest their money because of the levels of fraud. Default. Mississippi remains in default on some of its sovereign bonds from the late 19th century. And yet that emerging market emerges spectacularly, obviously, from 1918 onwards. Now, imagine had you been an investor in 1901, you worked that out. Very few investors did, but you worked it out and you placed your capital in America. And the next thing, by 1918, this is clearly the American century. What happened to the valuation of US equities over that period? Well, they went from 25 to 6. You picked the right emerging market, you picked it at the right time, and the valuation still came down because of the old Buffett truism, price is what you pay and value is what you get. And it doesn't matter if the market emerges, you picked the wrong price. And if you pick the wrong price, you'll get the wrong return, even if the emerging market emerges. As I said, this was complicated by rising discount rates within the United States of America over this period, but also another lesson from emerging markets. This market was heavily concentrated in railroad stocks. And railroad stocks were plagued with overcompetition, and clearly between 1901 and 1921 we began to work out the technological impact on railroads of the internal combustion engine. And that also began to undermine the returns from railroad stocks. I would argue that you shouldn't buy any stock market, unless you're trading it, you shouldn't buy any stock market on more than 25 times earnings. This one has been an emerging market. It became a global superpower. It invented consumerism from 1920 to 1929. It went through a deflation. It went through 2 world wars. It went through being the huge economic survivor after that Second World War. It's been back through high inflation in the 70s. It's had everything thrown at it, and yet equity valuations on the whole seem to trade between 25 and about 6 to 9 times at the bottom. So I think you can use this for emerging markets and anything else. And emerging markets are also, some of them are very expensive, most of them are reasonably priced. I'm just going to do a little quick bit on the bottoms. What is the point in discussing the bottoms when we're clearly at a top? Well, the real reason for discussing it, obviously, is I've written a book about it. So you shouldn't expect any author to stand up in public and not plug their book. So there is a book called Anatomy of the Bear. When I look at the 4 bottoms, 21, 32, 49, and 82, and I try to work out what they have in common. It is available in German, by the way, though everybody buys the English version, but it is available in German. Just briefly, it's deflation. Now, I just want to go back to that Gordon's dividend discount model and relate it to what happened in 2009. So 2007, business cycle peaks in December. We are doing a valuation of General Electric. We have to choose a discount rate. We have to choose a growth rate. And here's something else we have to choose. And we don't even think about this. It just goes in automatically, which is the discounting period. If you're working out the net present value, you have to work out over what period you discount back those earnings. Now, the further you go into the future, the more meaningless they are. Because if the discount rate is relatively high, those future earnings don't really contribute to the net present value at all, but at least most people just put in infinity. That's what most people put into that net present value calculation. And why not for General Electric? I mean, it's been in the Dow Jones Index, I think, from 1894, since there's been a Dow Jones Index. In 2007, it seems perfectly rational to put infinity for the discounting period into your net present value model for General Electric. And then in March 2009, the man who ran General Electric went to see the president and said they were going bankrupt because the commercial paper market had closed down. The company had managed its cash flows through the commercial paper market, and as it was unable to access commercial paper, it would have to close. Now, we know that that was so impossible that something was done about it. Commercial paper market was fixed with another Fed program. But on the day that you heard that the chief of General Electric was speaking to the president about the imminent bankruptcy of General Electric, what was your discounting period then? And in my opinion, that's why equities get very cheap when there's deflation, because we begin to contemplate that the equity may not survive, that it simply won't be there. The discounting period shrinks. Obviously, that earnings growth number has just collapsed, and equities get incredibly cheap. And what happens then is society as a whole has to decide to do something. Now, it has a central bank at which you can do something, or sometimes it's a government. Governments in the 1930s that were linked to the dollar, or linked to the gold, I should say, abandoned the gold standard because the consequences of the deflation were so bad for the economy. They gave up. They printed money. And for many of these markets, that was the bottom of the stock market, because society can't bear a deflation because of the societal impacts it brings, particularly in a highly geared society. And we are, and I'll show you charts on this, more highly geared than we have ever been in the history of the world. And I mean that for the whole world, clearly not for Germany, which is one of the few places in the world which is actually de-gearing. But you need a society that can make that decision. So I used to go and tell investors, look, there are only two scenarios in which you can lose money by buying equities with a cyclically adjusted PE below 10. One, communism, the sequestration of your assets. It doesn't matter if you buy equities at 10, 8, 6, 5, 4, 3, 2, or 1. You're going to lose some money. And of course, history is littered, particularly in emerging markets, with a confiscation of assets. The second, which pertains particularly to Japan, is the destruction of your capital stock by enemy bombing. These things have happened. I was really raising them because they're so extreme and so unusual to say that, you know, in just about any occasion you can buy equities below 10. This is the triumph of the optimist because they can discount just about anything. And society doesn't let that anything come to pass, and you make a lot of money. But there is now, of course, a third one, because it was certainly possible to stand up in front of an audience somewhere around 2008 and tell them to buy Greek equities with a cyclically adjusted P of 8. And then they went to 3. And the third one is when you have linked your currency to gold or something else, and you simply can't devalue. And in that scenario, your equity market could go to 0, because the decline in cash flows could be so gross that nobody can pay their debt, and the corporations are owned by the debtors and not by the holders of equities. So that is a third one. It's not a new one. We've obviously had currency unions before. But it is one worth remembering if we get a deflation breaking out again in certain parts of Europe. There is no central bank, local central bank, that can take that choice for society that they prefer inflation to deflation. And therefore valuations can go much lower than they can in an economy where they can print money. Now we know the downsides of printing money on the exchange rate. And you might lose a lot of money on the exchange rate. But the equity market likes central bankers that print money, when what they've been putting forward before that has actually been deflation and bankruptcy. Highly geared institutions love inflation, and there are plenty of them in the world today. Now, that was probably 20 minutes. We better move on. I want to briefly say why I think this works. You know, it's nice to observe that something works, but what is the intellectual framework for this? And I think it's really important when looking at investing in sectors of industry as well. And it feeds nicely into value investing, which is what we're currently working on with my course, is to try and get more value investing in it. I mentioned that the Q ratio, which is measuring equities relative to the replacement value of their assets, net assets minus debt and other liabilities. And this is both measures, CAPE and Q, relative to their own average. Now, what is striking is how similar they are, because one is measuring earnings and one is measuring assets. They're measuring two entirely different fundamentals, and yet relative to their own averages, they've followed a remarkably similar path. And I put this up because I think it's easier to explain with a Q ratio why this works. And I'm going to use the word reflexive, which has a very specific meaning. It's a phrase used by George Soros. And it contradicts everything that you're taught in business school. And what it says in this, business school tells you that the fundamentals are reflected in the price. And Soros argues that sometimes the price changes the fundamentals. Now, anybody who's been in a market long enough will realize that that is true. Not all the time, but sometimes. Now, I've looked in my book at the 4 times the Q ratio was really low. How low was it? Remarkably, on the day that the stock market bottoms, on all 4 occasions, it was the same number, a 70% discount to the replacement value of assets. It's incredible. I mean, why would anybody give away $1 for 30 cents? But it's happened 4 times now in the last 100 years, and as recently as 1982. Why would anybody do that? But it happens because they believe in the extinction of equity, as many people did in 2009. I was actually very bullish in equities in March 2009. Couldn't persuade anybody to buy them. They were convinced everything was going bankrupt. So what happens? So let's say I'm the managing director, you're the board. I come to you in March 2000, well, let's pick 1982. I come to you and say, I've got this great investment proposal. We're still cash flow positive. Got a lot of cash coming in. I've got this thing I want to invest in. I think it'll pay off in 5 years. I think this is a really great investment. And the board will say, well, what is your equity trading at? What is our equity trading at relative to the replacement cost of our assets? And I'll say, well, it's at a 70% discount. And you'll say, well, wait a minute. You're going to take 100 million US and you're going to invest it, and the market's going to value it at 30 million US. Yeah, that's what we're going to do. And they will say, pay a dividend. Give the investor 100 million, because it's worth 100 million, and don't be putting great big holes in the ground with 100 million if they're going to value it at 30. That's the reflexive nature of valuations. They change the behavior of corporations. Now, not every day, but at extremists, they will stop people investing money. They will stop boards from investing more capital. And there is no better time to buy equities at a time when A, they're trading at a great discount to replacement value, and B, they stop making more capital. And of course, the same is true at the top. If at the top I can invest 100 million and the equity market instantly values at 200 million, guess what happens next? Particularly if I have stock options. And it actually creates more investment. So the reason I think that this is ultimately a good measure of value is that it changes the behavior of corporations. Though, as I stress, more at extremes than in the middles, but it is all hyper and turbocharged by the use of stock options. So a little bit of sort of guidance as to what happens next. I don't believe that we have rising inflation, but if you do, equities will go up. Equities will go up roughly until inflation reaches 4%. So what I've got is a series of charts here which look at all the times US inflation has risen from a low level, risen above 4%. Why look at it from a low level? Because that's where we are today, so maybe that is of some practical use. And on all occasions when equity inflation is low and rising, the stock market goes up until we reach a level of 4%. And you can see that first happening in 1968. And the stock market from sort of 69 to 70 comes down from about 1,000. This is the Dow Jones to 700. We get inflation briefly under control in the the early 70s. You can see the stock market goes all the way back up to 1,000. But the dotted line is inflation. It breaks through 4% on the left-hand scale. The stock market goes from over 1,000 down to 600. You lose 40% of your money as inflation goes through 4%. I will come back and explain why, but let me just show you the other charts. It's not often noted, but in 2007 or 1987, when we had the spectacular stock market crash, inflation had briefly got above 4%. In the year 2000, inflation did not get above 4%, but it got very close to 4%. And at 4%, the stock market began to come down. And here we have 2007, inflation goes above 4%, and the stock market comes down. So clearly that is a rule of thumb. It's not, I don't know how much you could prove that by qualitative measures. But this is why I believe it works. Investors realize that as interest rates go up from low levels, they reflect higher growth. They're simply reflecting. The Fed doesn't know anything more about the economy than you or I. And what they're doing, the Fed is reflecting what's happening in the economy. And yes, your discount rate going up, but probably our growth expectations are also going up. And we don't believe that this higher level of interest rates will actually impede that growth. If you want, we believe the Fed is behind the curve. Historically, no one has believed the Fed is behind the curve when inflation goes through 4. At 4, people believe, well, even the Federal Reserve realizes what's going on now. And now we've got a different combination. It's not a slowly rising discount rate and growth expectations rising faster. What we now face is a discount rate rising to slow growth, that the Fed is targeting growth because it's the growth that's generating the inflation. And suddenly we're looking at lower growth and a higher discount rate, and our net present value changes. But it's really important to realize that has not historically happened until inflation gets to 4. Now, obviously it can be different this time. Maybe the debt levels are so high that we just simply won't get to that 4% level. I don't think we're going to have inflation, but if we do, then I think equities will continue to go up. But if they get close to 4%, be very careful. Now, I wrote that in the middle of 2009. I wrote a piece at the beginning of 2009 saying buy equities. And then I wrote a piece in the middle of that year saying, and hold them until inflation goes through 4%. And then I ignored my own advice. So I didn't do it. I should have just held and held and held, because inflation has not been through 4%. Not been through 4% since then. Now, it got very close in the first quarter of, I think it was first quarter of 2012. It got very close to 4%, but it didn't get there. And it's been a perfectly safe time to hold equities because we've had a period of growth, and what we've had is low inflation and therefore low discount rates. The reason for going back to this briefly was just to explain a political point. And I said I can't talk about everything in the time available. But how did the Americans get inflation down in the mid-1970s? This was the Republican administration under President Nixon. They brought in a price commission, the Office of Price Control. This is America. These are Republicans. They didn't put up interest rates. They set up a commission, and for any corporation that wanted to raise its prices above the rate of inflation, they had to apply to the commission. So I guess Max knows this because I've done this before, but who knows who who was the price commissar for America? Donald Rumsfeld. Donald Rumsfeld was kind of busy because he had 14,000 applications within the first month to raise prices. So he thought he needed some help. He decided to hire he would be the chairman. He hired a chief executive officer. Who was the chief executive officer of the Office of Price Control? Dick Cheney. Now, two individuals more to the right of politics, it's difficult to imagine, but they both ended up fulfilling effectively communist positions within the American economy as dictating prices to the American corporations. And why do I raise that? Because politics are important. And it's the other reason that we like to teach financial history. You know, this idea of taking markets out of the political spectrum and putting them into an equation and saying, in my case, I think President Erdogan, to say President Erdogan is irrelevant to the future of Turkey and the asset prices of Turkey seems to me a form of insanity. But that is what we do when we strip the data out and don't look at politics at the same time. So there are many, many examples of that, but we need to move on sharply. And just on this last one, before we go on to the outlook in the future, this is the most mean-reverting series in economic history, and it's US corporate profits as a percentage of GDP, and as you can see, we're at incredibly high levels. I've stripped financials out of that one. If we put financials in, you get a similar thing. There is a mathematical test for mean reversion called the Auty-Dickey-Fuller test, and if you run it, this one is incredibly mean-reverting. And yet, every time I see an investor, they say to me, this one isn't going to mean-revert this time. And some incredibly bright investors also believe that. So very recently, Jeremy Grantham has written the paper saying that he also believes now that this will not mean revert. Now, I strongly, strongly disagree with that because the things that mean revert this are a thing called society. Nothing to do with money, nothing to do with finance. This is society. We have corporations, particularly in the United States, that are benefiting greatly at the expense of labor, benefiting greatly at the expense of creditors, benefiting greatly at the expense of the taxman, and actually, at the minute, benefiting greatly at the expense of their own pensioners. They're actually winning against 4 sectors of society. Now, if you believe that that is the status quo, that in perpetuity the corporation will be that powerful that it will continue to triumph over all 4 other interest groups, then maybe. But there's nothing I can see in the history of the United States that would make me believe that. Remember, the United States has regularly produced presidents who have attacked the corporation. Teddy Roosevelt famously attacked the Standard Oil Company. Woodrow Wilson attacked the corporation. FDR famously attacked the corporation. Even John F. Kennedy attacked the steel companies. And it's easy to attack a company in America. You know what you do if you want to attack a company in America? You put the word big in front of it. And as soon as you put the word big in front of anything in America, it's fair game to be attacked by any politician. Because America is not about big. America is about small. It's about the small guy. It's about the American dream. It's about everybody having an equal chance. And sometimes in history that doesn't happen because the big guys take over. There is a measure of this oligopolistic behavior called the Herfindahl Index. And we've got incredibly high oligopolistic businesses right across the planet. And if you believe that's sustainable, then fair enough. You believe that's sustainable. But as long as we have politicians and democratically elected politicians, it seems to me unlikely that that is sustainable. The favorite to be the next president of the United States of America is the current president of the United States of America. The second favorite to be the next United States of America is the vice president of the United States of America. The third favorite to be the next president of America is called Elizabeth Warren. Now, I don't know what you know about Elizabeth Warren, but believe me, the stock market is not going up if Elizabeth Warren gets made president because this is one of the things that she'll be targeting, and she'll have a mandate from the people to do it. So I think you can make a lot of money just betting on the mean reversion of corporate profits relative to GDP. They've taken a hell of a long time to mean revert, hence we've had a very expensive market for a long time. But it's difficult for me to create a socio-economic model at which they can stay high. Though I have been asked, particularly in America, they say, why don't you're a smart guy, think of a way that this can stay up. How can it stay up forever? And I say, well, slavery. We could reintroduce slavery. Now, if we reintroduce slavery, perhaps the corporate can continue to take this share of GDP relative to labor. But in a normal market where labour mobilises to get a fairer share, it seems to me highly unlikely that this will not mean revert. Now let's get on to the future and a little bit of 15 minutes of speculation about the future. Now I believe in deflation, which I believe is not the standard view, but it really stems from debt. Now you might say, well, isn't deflation too much supply and not enough demand? And the answer in a normal deflation is yes. But the deflation we just lived through wasn't really that sort of deflation, was it? I mean, what happened is somewhere in the great big financial chain of leverage that goes around the world, somebody was unable to meet their interest payments and their principal payments. And that began in the United States of America, where people were unable to meet their interest and ultimately principal payments on their mortgages. It didn't begin with there being too many goods chasing too many things. I mean, inflation was actually rising all the way into the middle of 2008. Commodity prices were shooting up. So there is a narrative for deflation, which is, hey, too many goods, not enough demand. And it still works, but the way it works is this. Something happens in the credit system and a demand stops. And that's when you get deflation in the modern era. Now, the 19th century deflation was clearly different. There were, the opening up of the prairies, the industrialization that went on in the late 19th century, clearly huge production. But that was in an era with no debt, or very, very little debt. What we have today is an era of debt, where very quickly something can snap, demand can stop, and then you get deflation. And that's what happened last time. I'm going to argue to you that is what's going to happen this time. And here's why. We haven't solved our debt problem, we've made it worse. This is not debt in absolute, this is debt relative to the size of global GDP. This is from the BIS, by the way, so it's all the countries that report data to the BIS, and that's really just about everybody. It's a very good measure of total debt to GDP. As you can see, the major rise in debt is the government. Now, we're not so concerned about the government from a bankruptcy perspective. There are many other reasons to be concerned about governments, but bankruptcy usually is not one of them. What we're concerned about are the bottom two. Now, if you add them together, what you'll see is there's really been no change. I think it's 152% of GDP in the end of in the first quarter of 2008, 154% of GDP today. If the reason we had a great financial crisis was there was too much private sector debt relative to the size of cash flow, GDP, it's no better today than it was in December 2007. But interest rates are a bit lower. The ability for a central bank to respond to something going wrong in the credit system has been significantly reduced. So the fundamental reason I think we still have to be fearful of a deflation is because something's going to go wrong in this credit system. Now, what goes wrong in a credit system? And it has to be a falling cash flow. We all have borrowed money, I suppose, at some time, and you know that you're good for the money unless your cash flow comes down. And if your cash flow comes down, there's a prospect you're not going to be able to pay. So what I want to look is the global outlook for cash flow. Now, if you read the front page of the Financial Times, you would believe that everybody is awash with cash. And I'm going to give you the reasons why that is not correct and why that is untrue, along with many things in the Financial Times. So this is the OECD total broad money growth. So the good news is it's growing. I just checked it before I got here, and it's now growing at just 6%. So it's actually come down from that, and it's growing at 6%. One of the greatest lessons from financial history, that monetary policy is not just the price of money, it's also the quantity of money. It's growing at 6%. Look at the chart. That is the lowest level we've seen since early 2010. So OECD is basically the developed world. Now, unfortunately, I haven't run this back to the 1960s, but obviously it's astronomically high in the 1960s. We are running at levels of growth in money and across the developed world, levels that have only been historically associated with a recession. And you can see that in the 2001, 2002 period as well. It's not to say we're going to have a recession. Maybe we will, maybe we won't. But the prospect of runaway inflation in a world where the total amount of money in the developed world is growing at 6%, right at the low end of its historical range, doesn't strike me as being a land flush with money. And yet we keep hearing all the time that the world's flushed with liquidity. Well, the asset markets are flushed with liquidity. But the real economy is not. The aggregate data does not show that it is. So this raises at least a prospect that inflation isn't going up. So I say the crucial thing about this chart is that if you're running a portfolio, don't worry about inflation. Janet Yellen, as you're aware, is pondering why the Phillips curve does not work. Hasn't she heard that inflation is everywhere and at all times a monetary phenomenon? And this is the thing the Fed were supposed to be able to control. And after 8 years of extreme monetary policy, we have got one of the lowest levels of growth in money since World War II. So it doesn't mean a recession, but I think we can be fairly confident, barring a shock, i.e. an oil shock, that inflation is potentially not coming back anytime soon. But here's the real reason we have to be worried about this issue of money. Remember, I'm talking about deflation because I think there's too much debt in the world and not enough money. A lot of the growth in the world has come from emerging markets. Let's look at Indian broad money growth, Indian M3. This data actually goes back to 1963. We now have the lowest level of growth in money in India since 1963. Now, as you know, there was an issue in India almost exactly 1 year ago where they pulled back some banknotes and there was a temporary disturbance to the banking system, which is partially reflected in this data. But actually what's underlying this is that the state-run banks of India are short of capital. And they're not able to grow their banking system, or their credit books. And when a commercial banking system, fractional reserve banking system is unable or restricted in growing its balance sheet, then you do not get money creation. Money is not created by central bankers. It's ultimately created by commercial banks. Look at 2009. The world is falling apart in 2009. We're worried about deflation and collapse. And yet this major economy is growing total money supply at over 20%. Today, here we are with broad money growth in the developed world at 6. And in India, it's 6. This is one of the reasons that we got past that last deflation, because an economy like India was growing so strongly. At least the total amount of money was growing strongly. Real GDP growth was growing strongly, and they were generating some of the world's inflation. And China, similar picture. This is a country which has run on massive amounts of credit and massive amounts of money, and yet here we are with money right down at the bottom end of the range. The data for this country begins in 1978. This is the lowest level of growth we've seen since 1978. Where is all this money that's going to generate this inflation? Remember, we haven't had inflation since the great financial crisis, and all of these money charts are going like this. The central bankers have believed that the tightness of labour is sufficient to generate inflation, and their eye is off the ball on money. So I think that's, in a world of excessive debt and slowing money supply growth, we at least have to be aware there is another risk of deflation caused by a credit event. Debt is paid by money. If you can think of anything else to pay it, please let me know, because I would be delighted to find out what it is. But we don't have a lot of money to service all of this debt, and money relates to nominal GDP. Nominal GDP is low. China, has it solved its problems? Well, it hasn't solved its problems because its current account surplus keeps getting smaller and smaller and smaller. Anybody would think that China's going through some sort of renaissance in the last 18 months, and yet the current account surplus keeps shrinking. It's telling you that China has an overvalued exchange rate. That's why its money supply growth is slowing. How do you create an acceleration in money supply growth in an overvalued exchange rate? How do you hold up the value of your exchange rate relative to the dollar while printing ever more and more money? That link to the dollar acts as some form of constraint upon the total amount of money you can produce. Now, if the current account surplus was booming, if it was getting bigger and bigger and bigger, and all the pressure was upwards on the RMB, then clearly there's ample scope to print more money. But that's not where China is, and most of this current account deficit is coming through tourism. The Chinese are voting with their feet, and they're bringing huge amounts of money out of China, inevitably buying lots of stuff and taking it back into China. Tourism is one of the best guides to when a currency is overvalued. It's ordinary people voting with their feet, doing basic arbitrage. And the arbitrage of the Chinese people tells you this currency is overvalued. If this currency is to devalue, do we get inflation or deflation? This is, for consumer goods anyway, the workshop of the world. The dollar selling price of these products is not going up in a world where China devalues its exchange rate. So I don't believe in a collapse of China. I don't believe in the doom mongers saying that everything's going to fall apart. But this country is going to grow up. A country that grows up has its own monetary policy. It does not import it from the United States of America as the world's second biggest economy. It has its own monetary policy. And as soon as this country has its own monetary policy, i.e. gets rid of the link to the dollar, then the currency is coming down because its current account is coming down and its people are pushing capital out of the country. That's a deflationary impact. In terms of all this debt in the world, there has been a major redistribution since 2008. In that major redistribution, some countries, Germany being a classic example, private sector non-financial debt has come down in Germany since then. There's not many countries where it's come down, but in most countries it's stayed fairly steady. In America, there's been a massive redistribution. So the households have de-geared, but the corporates have re-geared. But the real growth in this number is in emerging markets. And you can see that growth on that top line. That's private non-financial debt to GDP ratio. And you can see how it just takes off. In 2009, interest rates are too low. The Fed drives rates low. Emerging markets keep linking to the dollar. Suddenly their corporations get access to cheap debt and they gear up like crazy. Now this is really, really important because most people look at the world and say, hey, I'm looking at the developed world and I'm looking at balance sheets which have been repaired. I'm not so sure about that for many countries, but let's say that that's correct. Balance sheets have been repaired. In the meantime, we've been trashing the balance sheets of emerging markets by adding debt at the fastest rate ever in the history of emerging markets. That's relative to GDP, that's not an absolute. And that's where the next crisis comes from. Now, I'll go on at the end. The BIS have done a nice little study of predictors for systemic banking crises. And they have produced a list of countries which they think will default. And most of them are in emerging markets. And yet emerging market risk, if you price it with the emerging market bond yield above treasuries, is at one of the lowest we've ever seen. So the reason I think that the market is wrong is we're focusing so much on the old problem and saying the old problem is fixed. We can discuss that. And we're missing the new problem, which is this excessive growth of debt in emerging markets. There's the total reporting countries. As you can see, it's not, when you add them all together, it's not dramatically higher than 2007. It's just a little bit higher, 154%. I think it was 152%. But the point was the debt burdens were so huge in 2007 that that's why a recession seemed to be almost becoming a depression. And we haven't solved the problem. We've got the same number, but this major redistribution towards debt in emerging markets. I think that probably speaks for itself. China's private non-financial debt to GDP. This is probably a good time to talk about the methodology on the BIS report. What they've done is they have, since the GFC, they've tried to run data back as far as they can for private sector debt to GDP. We didn't have that data set. We had lots of data on government debt to GDP, but not private. They then take all the data, having generated it, and they try to work out what predicts a systemic banking crisis. Can you think of anything more important than the BIS to be doing? And this is their conclusion. They take total debt to GDP. So total would include the government, it includes bank debt, it includes bond debt, it includes everything. And they look at the trend rate of growth in total debt to GDP. And then they look at the actual rate of growth in total debt to GDP. If the gap reaches 8%, that's 7 followed by 8%. If the growth rate of debt to GDP is 8% higher than the trend rate of growth of debt to GDP, there is a 76% chance that within 3 years your banking system will be bankrupt. Now, I don't believe it. I mean, it's simply I don't believe anything that's that precise. I mean, it's just, I've got great respect for the BIS. I think they are the best organization, supranational organization in the world at assessing these things. And Claudio Barrio, their chief economist, is a genius. But let's say they are right. What they're telling us is there are 16 countries in the world that are about to go bankrupt on their best measure of what predicts a systemic banking crisis. On top of the list is this one, because their credit gap is not 8%. Currently growing 8% above trend? No. Currently growing 30% above trend with a fixed exchange rate. Remember my comments about Greece? There was no flexibility to do something about it. Well, China finds itself in the same position, and to do something about it, it simply will have to abandon its exchange rate. So here's world inflation. This is the IMF plus its forecast. Where is it? This is its forecast out, I think, to 2020. Where is this inflation that's going to drive the world? It doesn't seem to be there, and I don't think we're going to see it in the short run. Maybe in Q&A we could talk about why in the long run we can get back to inflation, because I'm sure we can. But in the short run, there's no sign of this inflation that we're all fearing. This is why emerging markets are different and why they're riskier than everybody else. I'm sure most of you will have read This Time is Different by Reinhardt and Rogoff. And what you see in there is this little statistic. If foreign currency debt to GDP ratio exceeds 35%, there is a significantly increased risk of a credit event. Now, Germany does not borrow foreign currencies, nor does the United Kingdom, nor does the United States of America. But in emerging markets, there is a real proclivity to borrow foreign currencies. It's cheap. And people believe their currencies aren't going to fall. And then you can get these excessively high numbers of foreign currency debt to GDP. This transforms risk. This massively increases the prospect of a credit event because, look at the United Kingdom, we have been devaluing our exchange rate for a long time. I mean, as recently as 2007, it was 2.11 to the dollar. It was down to 1.20. Nobody went bankrupt because the currency came down, because nobody's stupid enough to borrow in dollars to invest in sterling cash flows. But in emerging markets, that would bankrupt people because so many of them have borrowed in a foreign currency. And what we're seeing is some emerging market currencies under extreme pressure. You know, the dollar may have been weakish for the past 6 or 7 months, but actually you still got some of these currencies coming down. Remember the trigger level from the Reinhardt and Rogoff study? 35%. Well, if you look down that list, you'll see a hell of a lot of countries above 35%. And I have to say this, most of them are in Eastern Europe. It's Eastern Europe that has some of the highest debt levels to GDP. Turkey, I think, is the one we need to look out for, and I'll now talk about Turkey. If I had to have a list of all the things that you would look for in a country about to default in its debt, Turkey would have every single one of them. It has huge levels of foreign currency debt to GDP. It's over 60% of GDP. Its interest rates, domestic interest rates, have doubled in 4 years. They've gone, the 10-year government bond yield has gone from 6 to, I think this morning it's just got to about 12. The 3-month interbank rate has gone from 6 to 13.5 over those 3 years. In September, we had recognition of the biggest private sector bankruptcy in the history of Turkey, which was a telecom holding company because it could no longer afford the interest on the $4.5 billion US that it borrowed to finance its investment in Turkish telecoms. Borrowed US, invested in local currency cash flows. And obviously we have a president who tends to be driving capital out of Turkey rather than putting it in. The rule of law is subject, let's just say, subject to some debate. The president has targets domestically. Some of those targets are wealthy, and they consider the best thing to do is to remove their country, money from that country. Things are moving rapidly in just the last month or two. Interest rates are shooting up. The currency's coming down. The central bank keeps announcing policies to stop it. All that happens is interest rates go higher and the currency goes lower. As someone who's been doing emerging markets for nearly close to 30 years now, that is the end game. It seems to me we're very close to the end game. It's taken a long time to play out for Turkey, but we're very close. Why do you care about Turkey? Because the world has a credit risk against Turkey of 410 billion US. That is our credit risk against Turkey. About 100 billion of that rests with European banks. There's another 100 billion in the banking system. And the rest is in the form of bonds. And the world is full of emerging market bond funds holding Turkish credit. So we care because it's big and it has an effect on the global financial system. How much were the liabilities of Lehman Brothers the day it went bankrupt? 600 billion. Well, Turkey's liabilities to the foreign financial system are 400 billion in credit. There'll also be equity risk, whether it's in the listed sector or direct investment. There's also risk there. And I believe that risk is about to come home to fruition. Now, will it have the same dynamic on the banking system that Lehman Brothers did? Almost certainly not. Not on the banking system directly, but it'll have a huge, huge impact on our perception of emerging market risk. The world is frightened of populism. And particularly when you say the word if you close your eyes and I say the word populism, guess whose face you see when your eyes are closed? It means the President of the United States of America. But the President of the United States of America is surrounded by a constitution. And at least yet, there is no evidence that he has managed to do anything against the Constitution. And I think we all know that if he does, he's heading in a very clear direction. Populism in emerging markets is entirely different because the constitutions are not strong. And presidents and prime ministers regularly smash through the constitutions. And when they do so, you should not be invested in that country. It seems to me bizarre that foreign investors want to invest in Turkey when you have a president who's reneging on basic property rights for his own citizens. The idea that you're going to be immune to that seems to me an incredible thing to do. And there's, once again, financial history is littered with people who were trusted until the day they weren't trusted. This president, by the way, makes regular speeches about the foreign loan sharks, how they're capturing Turkey and subjecting it to the slavery once imposed upon the Ottoman Empire. That's you he's talking about. That's your role that he views in this economy. So why do you care about Turkey? Because we will reassess emerging market risk. The next president of Mexico is out of that wild and wacky extreme left-wing stable that only Latin America can produce. He seems highly likely to win the next election. I think we can blame President Trump for that fairly and squarely by putting a Mexico in a corner. If you're worried about populism, my view is you should not be worried about populism in developed world countries where we have constitutions to defend us from those things, but you should be worried about it in emerging markets. So the whole emerging market risk will be assessed, reassessed, and in a bad way. In 1982, when Mexico went bankrupt, it was an emerging market crisis, not a Mexican crisis. And in 1997, when Thailand went bankrupt, it was an emerging market crisis, not a Thai crisis, because we re-evaluated the risks. And that's what's going to happen. All of these I list here are where cash flows are under pressure. You see, the standard view of the world is that growth is there, inflation's coming up, interest rates come up slowly, and there's no risk on cash. We all know there's so much cash in the world that everybody can pay their debts. Let's remember, Turkey's interest rates have doubled in 4 years. It is not true that the world is full of robust cash flows. Some cash flows are coming down and coming down quickly. In Japan, I'm really going to speed up now because I'm already way past, the Bank of Japan is targeting the yield curve and growth is coming back. What happens next? Well, imagine you own JGBs and suddenly you see the economy is growing. The stock market, as you may have noticed, is going like this in Japan. You don't even have to worry about inflation. You just might conclude that equities are a better thing to own than JGBs. So the Bank of Japan's balance sheet expands into an economic recovery. What we're witnessing in America is a central bank at least contemplating shrinking its balance sheet into an economic recovery. But in Japan, they're doing something entirely different because they have to, because they're out of savings. The reason that Japan has run its government debt to GDP ratio to 240% is they filled the entire savings system with government debt. The fiscal deficit's 4% of GDP. Who's going to buy them? The central bank. I mean, this is the Weimar Republic. They can't stop. That's the point about the Bank of Japan. And what we're witnessing now is America seems of it stopping. Let's just say the European Central Bank may be slowing down. Japan will actually accelerate because it has to buy these JGBs that are put to it by investors wanting to get into equities. And I believe the yen would fall significantly. There's a fantastic book on this by a chap called Peter Bernholz called Inflation and Monetary Regimes. And he looks at all the countries that have done outright monetary financing, and the first market that smells it and reacts is the exchange rate market. So I think the yen will fall. That's deflationary. The dollar price of Japanese exports will fall if the yen-dollar rate comes down. I lived through the Asian economic crisis. The yen went from 100 to 145. It was a key catalyst for showing up some of the weaknesses in Asia. I think it would be exactly the same thing again. I've discussed the RMB, German life insurance companies. I'll leave that to you. You might say, what on earth do I know about German life insurance companies? The answer is absolutely nothing. But I'm taking this from the head of insurance regulation at BaFin, who said that he cannot guarantee the stability of the system through the end of 2018. And I think if a regulator, a German regulator, says to you that the life insurance, there will be bankruptcies in life insurance before the end of 2018, I think we should pay attention. And if short-term or even medium-term bond yields come even lower in Germany, which they would certainly do in a deflation, certainly do in a credit crisis, even lower, it's hard to believe, but even lower, then the problem of cash flow for these corporations, many of which are mutuals, as you know, rather than listed corporations, will come up to meet us. Two quick things to finish. Capital controls. These are really important. The most important thing I'll say tonight is capital controls are back. Why? If the president of Turkey, and I do sound like I'm picking on him, but it's just that that's the one that seems to be the closest to rolling over. If he decides that the best thing he can do is impose capital controls, to bring down interest rates, get the economy going, stop domestic bankruptcies, then that is de facto a debt moratorium on all foreign liabilities. It's a de facto default. Capital controls, you think, well, what's that? Administrative policy, what does that mean? It means it's illegal for anybody in Turkey to pay back their foreign debt, pay their interest or their principal in a strong form. It's a debt moratorium. It's one of the biggest credit crises that we will ever see. And I think across the planet, capital controls are coming back. We have them within the euro. We have them in Greece and we have them in Cyprus. They had them in Iceland. These are developed world countries which have resorted to capital controls, and let's call them what they are. They're a de facto debt moratorium. And they spread the disease through the rest of the financial system, because in the rest of the financial system, principal and interest is not paid back. This is the most important thing for us, because most of us here have invested across the planet in a world without capital controls, and we believe it's the norm. Across the world, populists is voting for one thing. People are voting for one thing: more control. They see their democratically elected politicians without control. Control has gone elsewhere, whether it's gone to Brussels, or whether it's gone to multinational corporations, or whether it's gone to the World Trade Organization. It does not rest anymore in domestically elected politicians. Now, whatever your opinion on that is not really very relevant. The point is they want it back. And when they try to get it back, you get Brexit. But you can just as easily get capital controls. The proximate cause, the average man in the street attacks the proximate cause of the loss of power, and for whatever reason the people of Britain decided it was Brexit. But it can just as easily be capital, and the Prime Minister, the President of Turkey, has decided that it's capital, and that's why capital controls can make a comeback. That is how the politicians get leverage over capital. They stop it moving. That's what we used to do, and I think it's coming back. And finally, disunity in Europe. I don't have to tell you about the Visegrad Four, but basically nobody else in Europe seems to have ever heard of the Visegrad Four. And certainly nobody in the United Kingdom seems to have heard of the Visegrad Four. And they're making it absolutely clear that the degree of federation that Europe needs to make this euro work is not going to happen. I could go on and on about that, but you know more about it than I do. But I would just finish on President Macron. He's making incredible speeches at the minute, but nobody reads them. And that's just the nature of incredible speeches. Journalists are very good at reporting I think they report the first 15 minutes and then they run away to their laptops. Read any speech by President Macron and he says the following. He says, there is a Franco-German initiative. And the Franco-German initiative is to have open public debates on the future constitution of Europe. We will then decide as who is in fast-speed Europe, who's in second-speed Europe, and who's in third-speed Europe. Now, I applaud that. That is a long overdue, democratic, open consultation on what sort of federated Europe we want going forward. I think it's a wonderful thing. But there's a problem for financial markets. How can you have a two-speed or a three-speed Europe and one currency? So I'm going to leave you with a question rather than an answer. The conclusion from all of that is don't own equities. I actually personally own a lot of equities in Japan. I've hedged those into the United States dollar. They're already doing quite well. I think they'll do even better as the yen goes down. But that is very much, 1, 2, or 3 year play. It's certainly not a value play. I still own 30-year treasuries. I own Singapore government bonds. And I own lots of United States dollars, because this is a scenario in which emerging markets would come down, commodity prices would come down, and the United States dollar would go up.